Imagine this, it's your last day at work. You shut down your computer one final time. You walk out of your office feeling free. You're not worried about what job you'll do tomorrow because you know you've got enough to retire and live life on your own terms. Today, using all of my 24 years investing experience, I'm talking about how you can work out your retirement number. So you have your big financial goal and so you can retire when you choose. Chapter 1, what is your retirement number? When I say retirement number, I mean the total size of the pot you will need. Your investments, pensions, ISAs, so your money works for you instead of you working for money. Why does this matter? Because without a number, you're drifting. Without a target, you're hoping you've saved enough. But hope isn't a strategy. So step 1, set a number. Then everything else becomes a tool to reach it. As one of my heroes says, Arnold Schwarzenegger, if you don't have a vision of where you go, and if you don't have a goal where you go, you drift around and you never end up anywhere. If you are into taking notes, get this written down. Retirement number equals annual spending divided by safe withdrawal rate. And if you are serious about investing and potential early retirement, hit subscribe so we can build wealth together. Chapter 2, the 4% rule, what it means and how to use it. One of the most used rules of thumb is the 4% rule. In short, at retirement, you withdraw 4% of your portfolio in year 1, then increase that amount each year for inflation. For example, if you retire with 500k, you withdraw 20,000 in year 1, then maybe 20,400 the next year if inflation is 2%. It's a big if based on the last few years, but the 4% rule is a simple rule that at the very least gets you thinking about retirement. In the US, this came from the Trinity study. In the UK, it's used as a starting benchmark. For example, with £1 million, you could imagine 40,000 per year as a rough target. But, and this is important, it's not a guarantee. Here's why. It assumes you'll spend fairly steadily over 30 years. Your investment mix is similar to what the research used and markets behave reasonably. In the UK, recent commentary suggests caution. Market returns, inflation, longevity and tax rules have changed. So we'll use the 4% rule as a foundation, but some people don't like it. I do because it's simple. And again, it gets you thinking so you can start planning. As always, nothing in this video should be taken as financial advice, and the full disclaimer can be found below in the description. If you need to see a financial advisor, then all good. This video will help you to understand what they are actually talking about. Chapter 3, calculate your number, step by step. Let's walk through it together. Grab a notepad or pause the video now if you need to, because we're going to calculate your retirement number. Step 1, estimate your annual retirement spending. Think about your lifestyle, where you live, how you'll travel, what your hobbies will cost. Let's say you estimate you'll want 35,000 per year in today's money. Step 2, decide your safe withdrawal rate. We'll use 4% as a starting point, so your multiplier is 25 because 1 divided by 0.04 is 25. If you prefer more safety, you could use 3.5%, or if you accept more risk, maybe 4.5%. But let's keep 4%. So now, for example, 35,000 times 25 is 875k. That's your headline, your big retirement number. You now have something to aim for. If you want more than 35k per year, or maybe less, use the calculation to work out your own unique retirement number. Step 3, adjust for UK specific factors. Do you expect a full UK state pension, for example, currently 11,500 a year, which reduces how much you need to withdraw from your pot? Do you have other income sources like property rental, part-time work, ISAs? That again reduces the number. So if you expect 11,500 from the state pension, your required drawdown becomes 23,500. Multiply that by 25 gives you 587k. Step 4, consider inflation, longevity and risk. Because you may live 30 to 40 years in retirement, you'll want to keep some margin. Many UK advisors suggest the 4% rule as a guide, not a guarantee. So you might add 10 to 20% buffer to your number, 650k in our example, to feel comfortable. Chapter 4, real world variables and adjustments. Here are the real life variables that affect your number. Don't ignore them. Variable A, market returns and investment mix. If your portfolio is heavily in cash, low return, you'll need a bigger pot. If more in equities, high returns but more risk, you may adjust differently. Variable B, sequence of return risk. If you retire right before a big market drop, early withdrawals hurt the long-term pot more. Some UK advisors recommend guardrail strategies rather than fixed 4%. If you're not sure what sequence of return risk is, you can Google it or maybe ask ChatGPT for a full explanation. Variable C, longevity and lifestyle changes. You might spend more in the early years, travel for example, less later. You may live into your 90s. The rule was largely modelled on a 30-year time horizon. Variable D, tax wrappers and UK specifics. Make use of stocks and shares ISAs, tax-free growth, use a self-invested personal pension, a SIP, with tax relief again. These reduce how much you need in your pot because you pay less tax and grow more efficiently. Variable E, other income sources. If you rent a property, have dividend income, part-time work, etc., your number falls. So when you share your headline retirement number, really think about it and try to be flexible because it's not set in stone. It's a goal to aim for. You can adjust it upward for more safety or downward if you accept risk, another income or later retirement date. Chapter 5, taking action. How to reach your number. Now you've got a number. What next? Here's your action items. Action 1, break it down into savings targets. If your goal is 875k over 15 years, work backwards. How much do you need to save each year? Investment growth assumed. Use a spreadsheet or calculator. Action 2, prioritize tax efficient vehicles. Maximize contributions to pension, SIP, get tax relief. Use ISAs for tax-free growth. Consider employer pension match if you're still working. Action 3, monitor and adjust. Once you retire, don't apply 4% rigidly. Monitor investment returns, inflation, tax adjusted withdrawals if needed. Action 4, build margin and flexibility. Have a fallback, part-time income, a buffer pot, alternative assets. This gives freedom to adjust if the plan falters. Action 5, visualize your lifestyle. Often people underestimate spending in retirement. Visualize your ideal day at age 60, 65. What does it cost? Then build your number around your life, not just enough. Remember, the retirement number isn't just a spreadsheet number. It's the key to freedom. The number gives you choice. With it, you can stop being a slave to the income, your job, and start living on your own terms. Summary. So here's a little recap. Define your annual retirement spending. Choose a safe withdrawal rate. We used 4% as a benchmark. Calculate your headline number, spending times 25. Adjust for state pension, other income, risk tolerance, and longevity. Use tax efficient vehicles, monitor, adjust, etc. Your number isn't a prison. It's a launch pad, a starting point. It's today is a day you stop hoping you'll have enough and start knowing you will. Start with the number, then let everything else revolve around achieving it. I say this all the time. Education leads to financial literacy, and financial literacy leads to financial freedom. If you want to know how to retire early with index funds step by step, you can watch the last video in this playlist coming next.